The Reserve Bank has hiked the repo rate. That's the rate at which the central bank loans money to commercial banks. It's by 75 basis points.
This brings the repo rate to 6.25%. A loan at the prime rate from your bank will now carry interest of 9.75%.
It comes as inflation has climbed in the past 2 months. Other central banks, including the U.S. Federal Reserve last night and the Bank of England this morning, also raising their repo rates by 75 basis points.
Against this backdrop, the MPC decided to increase the repurchase rate by 75 basis points to 6.25% per year, with effect from the 23rd of September 2022. 3 members of the committee preferred the announced increase. 2 members preferred a 100 basis points increase. The level of the repurchase rate is now closer to the levels prevailing before the start of the pandemic. The revised repurchase rate path remains supportive of credit demand in the near term, while raising rates to levels more consistent with the current view of inflation risks. The aim of policy is to anchor inflation expectations more firmly around the midpoint of the target band and to increase confidence of hitting the inflation target in 2024.
The governor also pointing out that international events are still having a big impact on our economy.
Russia's war in Ukraine continues to impair production and trade of a wide range of energy, food, and other commodities. The supply of energy to the euro area is limited as winter approaches, placing immense strain on households, businesses, and governments. With rapid inflation and monetary policy normalization, the United States may also experience slower economic growth. While China's recovery from the COVID-19 lockdowns has strengthened, economic growth is expected to remain below longer-term trends.
The Reserve Bank also adding that the flooding in KwaZulu-Natal and load shedding contributed to a contraction of 0.7% in the second quarter of this year.
This year, the SARB expects the South African economy to grow by 1.9%. Growth in the first quarter of this year surprised to the upside at 1.7%. In the second quarter, flooding in KwaZulu-Natal and more extensive load shedding contributed to a contraction of 0.7%. Growth in the third and fourth quarters is forecast to be 0.4% and 0.3% respectively. The economy is forecast to expand by 1.4% in 2023 and by 1.7% in 2024, above previous projections.
For more on this, I'm joined by Tertia Jacobs, Treasury Economist with Investec. Tertia, good evening. Thanks for your time tonight. So we're all going to be feeling the pinch just that little bit further following this interest rate increase.
Yes, I think the increase in the repo rate of 75 basis points were expected, although you say it is coming with some pain. But I think the surprise for us was, how serious the Reserve Bank views the inflation situation, with 2 of the 5 members actually favoring a 100 basis point rate hike.
Mm. And that in and of itself gives an indication of what else then we can expect, Tertia.
So going forward, this is going to be very, very interesting. The repo rate at 6.25% is now basically back at levels pre-COVID, when the Reserve Bank then cut rates aggressively to 3.5%. So all of that accommodation has been taken back, and the big change actually how we and the Reserve Bank initially viewed this path of normalization was that it was supposed to be gradual, and then we had a host of dynamics around the world, from the Ukraine war to the KwaZulu-Natal floods, the U.S. Fed hiking rates more aggressively. And that has actually forced the hand of the Reserve Bank to also implement more aggressive rate hikes. So the point here is we are now approaching the level where, in economic terms, where there's a neutral rate, right, where the interest rate is supposed to contain inflation and growth. So going forward, the reaction function of the Reserve Bank is certainly going to be very interesting.
Does that mean that we can still anticipate even more aggressive hiking cycles, given the fact that we've gotten here much sooner than would have been anticipated?
I think that is the big question we are all asking ourselves. Because when you look at the Reserve Bank's inflation forecast for next year, although it remains, relatively high, between 5.5% to 6%, the outlook did not deteriorate. But I think the focus is on the balance of risks that remain to the upside. And those risks consist of where is the rand going? The Reserve Bank used a starting point for the dollar-rand exchange rate of 16.90 in its forecast, right? And the rand is trading at about 7.50 rand against the dollar. So that is very important because, there's we're paying more for imported goods, which drives inflation higher. So that is an uncertain factor. Then, of course, where's the oil price heading? Yes, we have seen the Brent spot oil coming back very nicely over the past month, which is a function of weaker demand. But at the same time, the energy crisis in Europe and the dynamics in Russia and Ukraine means that there could be further oil shocks ahead. And then, of course, we're waiting for what's happening in the public sector wage, the negotiations taking place. So all of that makes the outlook for inflation highly uncertain. So it's very difficult to make a very firm forecast now in view of all these many moving parts.
Definitely lots of moving elements, as you're saying, that ultimately have a bearing on the decisions that the Reserve Bank then will ultimately make. Tertia, I want us to bring it home for you and I, ordinary consumers. What does all of this mean? What do we need to keep in mind then going forward, especially when it comes to our credit?
So I think if I can just put the current interest rate into context, right? So we are back to where we were now in early 2020, March 2020, before the Reserve Bank cut rates to 3.5%. We're back. So one can reason that this is more like a normal policy rate, that the rates we have seen during COVID has actually been exceptionally low. So the current rate is more a neutral rate that we should have over the long term. I think where the issue comes in has been the pace of rate hikes. As I said, when we started the conversation, we expected a gradual rate hiking cycle, and all of this rate hikes has now happened between November and September. And in addition to that, the inflation is also relatively high. So this is then playing out in the context of what kind of salary increases people are receiving. So for now, they could be, disposable income can come under pressure, but with a salary increase now, when you look like 6 or 9 months down the line with inflation expected to come lower, hopefully coming lower, people's disposable income should start to improve now. So I think, the short-term dynamics could be more challenging, but over the medium term, we all should be in a better position where inflation doesn't play a big role in your decision making, where it's more a neutral factor. So I think, it is challenging now, but there is a broader story. So for each individual, it comes back to just more careful planning and the way that you spend your money, because there is more upside risk to interest rates, but it is for the purpose of containing inflation over the medium term that, spending power would again increase.
All right, Tertia, let's leave it there for tonight. Tertia Jacobs, she is a Treasury Economist with Investec.